Everyone, welcome to Finance Friday. Welcome back on the ARC UK network. I'm Hard Money Jim, and speaking today again from Jackson Hole, Wyoming, my home office, where we're having a better than usual summer because the tourist traffic is down a little bit. Now, I missed you last week because I was attending the wedding of a friend, some dear family friends. And it was a great wedding. And these days you hear a lot of innovative wedding vows. And I half expected to hear some vows like this on this Grant's cartoon, since I'm so preoccupied with the financial markets, through credit expansions and credit contractions till death do us part. But we didn't hear that. As it turned out, it was a pretty traditional wedding. And the couple who got married seemed happy and oblivious to the economic events that are now unfolding. So today I want to update you on the effects of this, what I'm calling a raging inflation that we're in. And I'm going to go over the latest CPI data and discuss some of the other collateral damage beyond the higher prices that we're living with. And we'll discuss the effect of inflation and of the Fed's response to it on the investment markets, both now and prospectively. I'm going to give you my thoughts on what I think the Fed is going to do or likely to do from this point on. And finally, at the end, I'll leave you with a little bit of a homemade parable that might help you explain over a beer to a friend what the nature of inflation really is. So first, let's update the inflation numbers. You are used to seeing this chart, but it's updated. It's the record of the exploding U.S. consumer prices. The CPI annual increase came in a few weeks ago at 9.1%. But let's always remember that that inflation is really excessive money creation caused by government. And high consumer prices like this are just one important symptom of inflation. Other symptoms include high asset prices, like when stocks, bonds, houses, and art go way up, malinvestment, excessive speculation, unjust wealth distribution, stagnating growth, and so forth. You might remember from our last discussion that stagflation, or slow growth accompanied by rising consumer prices, is actually a feature and not a bug of excessive money creation. Now, inflation, consumer price inflation is not just confined to the USA. These are the latest UK numbers, which has now surpassed the USA in consumer price increases, moving toward 10%. Now, look at that. That is a real spike in consumer prices. It's up from 1% just a couple of years ago, actually 18 months ago, to nearly 10% today. And here are numbers from other major countries. This is from the Financial Times. And you can see that everyone is facing some major increase in consumer price inflation. And let us always keep in mind, and I will not let you forget, that the primary cause of these soaring prices is money growth. This red line shows the total volume of broad money created in the US. It's USM2. It's now up to about $23 trillion, up from 15 trillion only a couple of years ago. The blue line, which you read on the left, is the annualized rate of increase of that money supply, which was already high before we got to the big pandemic stimulus QE of 2020 and 2021. So it was QE that monetized huge federal spending that was put directly into the hands of investors, consumers, and businesses. As a result, stocks went up, house prices went way up, and finally, now consumer prices are going way up. And by the way, the money creation caused by QE was not just in the USA. Here in this graph, this is from the Financial Times, is a graph of the combined balance sheets of all central banks in the world. And remember that every dollar of increase on a central bank balance sheet is an increase in the money supply. The combined assets of the world's central banks went from 4.7 trillion in 2002 to 22 trillion in 2012 to 42 trillion in 2022. And that doesn't even count the increase of money on the balance sheets of commercial banks, which would make that number even higher. So just on this graph, this is a growth of nearly 13% per annum. And I submit it's impossible to have, not to have some kind of price inflation under these kind of conditions. Okay, so there's an update on the CPI and the money aggregates. But now let's ask, what is the fallout? What is the damage that's caused by this soaring money creation and these higher consumer prices? So I want to now take a quick tour through some data that explores the effects of inflation on wage earners, on investors, on holders of cash, and on homeowners. And as we're going to see, inflation is no longer helping asset owners, and it's now hurting virtually everyone. Okay, so first, wage earners. They have suffered. Wages are not keeping up with consumer prices. Remember, if all prices and wages went up and down in lockstep, a rapid rise in consumer prices really wouldn't be a problem, would it? But as it always happens in an inflation, the effects of higher prices are not evenly spread out. And you can see in this chart that the rate of the hourly wage increase in orange there has topped out, at least temporarily, well below the consumer price increases. And consumer price inflation is not just affecting low-income people, although, I mean, they do suffer the most. But I read in a Bloomberg article a few days ago that said more than a third of Americans who earn at least $250,000 a year are reporting that they are living paycheck to paycheck, which tells us that inflation is taking a bigger bite out of Americans' budgets at all ends of the pay spectrum. Because $250,000 is that per year is at the top end of wage earners. It's in the top 5% of wage earners, excuse me. So price inflation's taken a bite from everyone. Now, I thought I saw this little cartoon on Twitter, and I thought it captured this phenomenon pretty well. This poor guy just got a 3% pay increase, but he keeps sinking more underwater as CPI increases are revised upward. So, you know, everybody's getting, and we've made this point before, everybody's getting hurt by this price inflation. Okay, so what about investors? You've seen this chart before too. The Fed has, of course, responded aggressively to higher consumer prices, and now investors are suffering. The year-to-date total return on this Bloomberg aggregate bond index, which is down 13% so far this year, is by far the worst in the 44-year history of this measure. Now, the chart says down 15%. This chart is about a month out of date, and the bond market has ticked up a bit since then, but so it's that bottom number should be 13, not minus 15. All right, so U.S. stocks, let's take a look at those now. And this is a kind of a big part of this talk because I think they're vulnerable. U.S. stocks are down about 17% overall this year, some much more. And that is a big move down, but I think they could decline even more. And so now let me explain why I think that. So the blue line here is the S&P 500 red on the left-hand scale. And it's dropped, but you can see it's still much higher than it was at its pre-pandemic levels. Those numbers aren't too clear, but back in 2019, it's still much higher than that. And when I looked at the S&P index this morning, it was at about 4,000. So we use that as its current level. Now, the black line shows forward 12-month Wall Street analyst earnings estimates, all averaged, all composite, and then averaged per share for the S&P 500. So that number, when you work out all the math, it's about $230 per share. It's what Wall Street analysts are, as a group, estimating for earnings on the S&P 500 stocks. So that means that at present levels of both these estimated earnings and the stock market level, the S&P level, we're at a PE ratio of about 17.4, which is a little bit above the average long-term valuation on the S&P 500. So by that reckoning, the market is close to fair value if the earnings are right, but it's not really cheap. It's not a great bargain. It's at an average multiple. Now here, by contrast, is another view of price to earnings. This is called the Shiller price earnings ratio. It's done by Robert Shiller, the Yale economist. And this averages historical earnings on a 10-year rolling basis and then adjusts those earnings for inflation by the CPI, when I say adjust for inflation. The idea is to look through the economic cycle and get a normalized inflation-adjusted measure of normal earnings, and then compare the current stock price, which in this case is the S&P 500 composite, to that normal measure. So the Shiller PE ratio right now is currently about 29 times. That's a very high, versus its long-term average of 17. So by this measure, the stock market looks pretty overvalued, like maybe it could drop by as much as 40% from present levels. Not a prediction, but that would bring it back to sort of long-term averages. Now, let's talk about earnings for a minute. What about these record high earnings that we are seeing? We are seeing record high earnings, and those record high earnings are being projected by the analyst estimate. That's what you just saw there. The market's valuation, of course, depends on the profits or the earnings of all the component companies. And as you can see from this graph, those earnings have never been higher. And they're at major new highs. And the question is, can the market's earnings be sustained, or are they too optimistic? So the problem, in my view, is going to be the denominator of this PE ratio, and that's the earnings. Unless the money printing continues, I do not see how these earnings can be sustained. Now, I have stated many times on this forum that company profits are elevated by excess money creation. And this is because most costs are historical. So a company spends cash for an investment or labor or inventory, and then as time passes, the government pumps a lot of new money into the economy, increasing the price of everything. And when the finished goods at the company are finally sold and the historically lower costs are subtracted from sales, the profits are exaggerated. Now, I think this has clearly happened over the last 2 years, and you can see this in the net profit margins that have gone up on the right-hand side of the chart. Beginning about the first quarter of 2021. The current profit margins are elevated well above pre-COVID levels, as you see, which were already historically high. When the money supply stops growing and financing conditions get tighter, as what happens during a recession, these profit margins, I think, are likely to shrink. So we'll do a little back of the envelope math here. Just say the projected profit of 230 per share that I mentioned a minute ago on the S&P 500 drops 20%. That would be down to $184 per share. 20% drop would be a normal for even a mild recession. And then let's suppose further that the market trades at 16 times earnings. That would lead to a drop in this number of the S&P 500 number, I'm sorry, to below 3,000 from its current 4,000. That's a drop of another 26% from present levels. And that does not account for a severe recession, nor does it account for a severe sell-off reaction resulting in a below average market multiple. So, bottom line is, I think the big risk to stocks today is on the downside. I think we have to see lower earnings, perhaps much lower, unless the inflation is continued, and we'll therefore see valuations based on a lower multiple of those earnings because of a reaction. Anyway, when it comes to stocks, in my opinion, look out below. Of course, I could be overly bearish. I have been accused of that before. So understand, this is my opinion. It is not investment advice. But any way you look at it, stocks and bonds have been a problem this year. And it's not just U.S. stocks and bonds. Jim Cramer from CNBC likes to say there's always a bull market somewhere, right? And usually that's true, but not this year and not now. And this graph from Bianco Research tracks 11 different asset classes. They're stocks, bonds, and stocks and bond funds, U.S. and international. And it tracks the best performing of those assets going back to 1978. So the vertical lines show the performance of the best performing asset class in the first 6 months of every year, back from 1978. And as you can see, every year, there was some asset class somewhere that made you money. There was a bull market somewhere that made you money, except for 1984 and 1994, where you lost a little bit of money. But now look over to the far right at the current period, the first 6 months of 2022. The best asset class, best performing asset class, lost 13.5% in the first 6 months. We have not ever seen such a negative 6 month period for worldwide investment returns. And remember, this is showing the best performing asset class. So there's been no place tied. And in case you were wondering, if you hoarded cash, that didn't work much either because of the loss of purchasing power. Over the last 10 years, you lost a lot, and now your cash is eroding at 8 to 9% a year. Now, you have to hold cash. You don't have any choice. But the point I'm making is this has just not been a very good year for investment returns so far. Okay, now, finally, let's look at what may be which is the housing market, home prices. They still look okay. The June median home price index in the USA hit an all-time high of 416,000. That's up 13.4% over June 2021, and that marked 124 consecutive months of home price increases. Quite a roll. But there are some signs that the housing market is rolling over and could be entering some difficulty, and that's this chart right here. The Mortgage Bankers Association reports that mortgage applications have dropped to a 22-year low, and that is shown on the right-hand side of the graph. And mortgage interest rates are down off their high of 6%, but they're still very high relative to recent years. And the combination of high home prices and higher mortgage rates is having a negative effect on affordability. So the affordability measures are now back to their 2007 levels, which was just before the big housing bust of the great financial crisis. So housing prices look a little shaky at these levels, but they have not fallen so far. at least not in the reporting we get. And we don't seem to have a bank capital problem today like we had back in 2008, which once the downturn got going, it contributed to the declining house prices. So house prices might hold up okay. My guess would be we'd see some weakness and a housing slowdown as we enter a recession, but I don't know about a major price decline. I wouldn't predict it, nor would I rule it out. But in general, economic activity is slowing. But of course, measured CPI inflation is still climbing, and the Fed is reacting to this rise in consumer prices. So before we get into what the Fed's going to do next, let's pause here and see if anybody has comments, questions, or a chat.
So we have a super chat from Jeff Bannister. Thank you for your super chat. And he didn't say anything in the super chat, but he did say something in the members chat. And I'm not sure if it was a question, but he asked, tourism is bad, question mark.
What was the question? I missed it.
The question was tourism is bad. And I'm not sure if he meant to ask, is tourism bad right now, or if it has any correlation.
Oh, tourism. I missed it. I missed it, Daniel. I'm sorry. Tourism. Oh, well, I think we have some particular reasons for lack of tourism here. For one, our airport was closed until late June. For another, Yellowstone Park, which is just a few miles up the road, had a big washout and a bunch of the roads are closed up there. So I think people have been discouraged. And so I also suspect that, most of our visitors, many of our visitors drive through with their SUVs and campers, and the price of gas might be scaring a few people away. So that's just a guess. My view is we're off tourism here off about 20% from last year, which was a record high. So I don't regard that in itself as necessarily problematic. To a mere resident like me, it's nice to not to have so much traffic when I head out on the highway and take my mountain bike out to hit the trails. So that answers the question. All right, so let's talk about then what is the Fed going to do? So first, let's remember that the Fed is trying to manage a consumer price index, because that is what they think inflation is. And they're trying to manage an unemployment number because that's their proxy for solid economic growth. I mean, managing inflation by controlling prices, I think, is like saying you'll cure an infection simply by lowering the patient's temperature. Even if you have to put him in a tub of ice water, but you could easily get the patient's temperature down if you freeze him to death. And that's one big risk that the Fed faces. The risk is that, killing the life of the economy through some deflationary actions. The Fed's been pretty aggressive so far, but there's evidence that many on Wall Street think the worst is already over. This graph shows how Wall Street economists in aggregate have expressed their inflation expectations over the last year. I think this is a fascinating graph. The light lines, descending lines, show the path of consumer price inflation that these economists in aggregate expect. And note that at every point since mid-2021, they have said right now is peak inflation. When inflation was 4, they said that's peak. When inflation is 9, they're saying that's peak. Okay? And they're saying further, as you watch the line go down, they are saying that inflation will revert back to the Fed's goal of 2% within a year or two. And note that no matter how many times they do this, and that no matter how many times they're wrong, they keep repeating the same pattern. I don't know why they just can't look at their past inability to predict and say, I don't know. I can't predict it, but that's not what they do. So understand, these are the same people who said inflation was transitory, and now they say inflation is peaking. So I suspect there's a little bit of complacency among the inflation observers. Now, it is true that commodity prices and gas prices and so forth have declined from their highs. They're still very high, but they've declined at least for now. But I think the CPI numbers are going to be high for a while. And remember, that's what the Fed reacts to. So let's try to understand a little bit why the inflation numbers literally cannot come down anytime soon. And this chart from Bianco Research is, I think, very good in explaining that. These are monthly CPI reports as reported by the Bureau of Labor Statistics. So if you take look at the most left red line there, July 2021, and you go through to July 2022, each one of those, and you add up each one of those monthly inflation numbers, you'll get the current rate of 9%. Okay. Now look at July, August, and September of 2021 in red. And you'll see that these are pretty low numbers. And as the July 21 number rolls off and isn't included in the 12-month total anymore, the next July's number has to be below 0.56% in order to get an annual number below the current 9% run rate. So even if the coming July CPI reading is zero, even if it's zero, the inflation print is still going to be well above 8%. Now, if you looked at these numbers closely, you could see that and did the math, you would see you would actually have to have big price decreases to get a full year, year over year inflation rate back to anything resembling the Fed's goal of 2%. And no one expects this. No one expects that. So I would add that the Cleveland Fed, which has its own forecasting unit, is currently forecasting a July annualized CPI rate of over 10%. So in addition, you consider the growing influence of sticky prices on the consumer price index. And we have every reason to think high consumer price inflation is baked into the index for many months, maybe even a few years to come. So I think high rates of increase in consumer prices are baked into the economy for months or years. And I suspect consumer price inflation is going to be nagging and it's going to be persistent. And if that is true, this gives us a clue as to how the Fed is going to act in coming months. So with that premise, what is the Fed going to do? Let's put together a few facts. The rate of increase in consumer prices is what the Fed reacts to and what they base their policy on. Their tools to control consumer prices are, short-term interest rates, which they set directly, and money supply, which they control by adjusting the size of their balance sheet, by buying and selling bonds. And they use higher rates and slower money growth to kill asset prices or increase unemployment in order to reduce demand in the economy. Now, the stock market is down, but I contend it hasn't really reacted strongly to the policies so far. Earnings are still too high, like we just talked about, and they're likely going to roll over as money gets tighter. And many people are complacent. They think inflation is going to come down fast, but historically that does not happen. The Fed thinks that failing to control inflation, meaning control consumer prices to them, is worse than causing a recession because unemployment affects just a few, while inflation affects everyone. So given all these assumptions, I think the Fed will continue to tighten. The political price of CPI inflation is just too high for them not to. So I think the Fed's going to cause some unemployment as a cost of controlling inflation. They were blindsided by consumer price inflation, and they look foolish. And to do their job right and to regain credibility, they have to get the rate of consumer prices down. So now let's look at their traditional tools in a little more detail. First, let's look at interest rates. The Fed has signaled another 75 basis point increase on their meeting on July 27th, and they're very likely going to raise rates several more times after that at a subsequent meeting. How much is the Fed going to hike rates? So here's a fun fact. Look at this chart. The Fed has never stopped hiking rates in past tightenings until the short-term rate was higher than the CPI rate. Now that makes sense if you think that the CPI increase is a good measure of inflation, because if interest rates are below the rate of increase in the cost of living, it makes sense to borrow to consume, and that would probably stoke more inflation, which the Fed's trying to control. So for short-term interest rates to be above the CPI inflation rate, CPI inflation has to come down a lot, or the Fed has to raise rates a lot, or both. So I could easily see ultimately a Fed funds rate of up to 5 or 6%. It's currently at 3%, while CPI inflation, which is currently at 9+%, is moderating down to the 4 to 5% range. But just as we showed a minute ago, this is going to take months at best and maybe years to get that done. So I think we have to settle in for a lot more interest rate hikes as CPI inflation subsides slowly, if it does. And the tight conditions should continue to put downward pressure on stocks and bonds and house prices for a long period of time. Okay, now from the Financial Times, here's an analysis of the balance sheet reduction that central banks around the world intend to do for the next couple of years. This is being called quantitative tightening, which means the Fed will just reverse its balance sheet expansions of the last 12 years. What they'll do is they'll probably just let bonds run off the balance sheet. That is, they're going to let some of their bonds, mostly mortgage-backed securities, mature and be paid off. But it's not likely they're going to sell treasury bonds, as that would outright sell treasury bonds. They might let some run off, as that would put a lot of pressure on the government bond market. So I assume their balance sheet will shrink, but not very much, because a big shrink could be pretty catastrophic to the bond market. And one big caveat here, the Fed has talked a lot about letting its balance sheet shrink, but today they really haven't done it. To date, they have not done this. Their balance sheet is not growing any longer, but it's also not yet shrinking. It's down like $8 billion on a $9 trillion balance sheet. So I would say if they do not keep their promise to let the balance sheet shrink, that would probably further erode their credibility. And by the way, quantitative tightening is a truly deflationary move. And here's how that works. Let's use a mortgage bond as an example. So as homeowners pay off their mortgages, they pay the lender, which has now become the Fed, because the Fed bought the mortgage-backed bond. They pay the lender, the Fed, and when they do so, the homeowner's money leaves his checking account and goes to the Fed. The Fed presents that homeowner's check back to the homeowner's commercial bank, and the bank honors the check by paying the Fed its reserve. So it reduces its reserve balance at the Fed, and therefore clears that check. The asset, the mortgage bond, is no longer owed, so it's now retired. The homeowner's money is gone, and the bank's reserves are gone. This is an example of how money is destroyed. That's deflation. That's deflation. Okay. Now, the path that the Fed is on is that it's going to raise rates and allow its balance sheet to shrink enough to damage the economy, probably by killing the stock market or by raising the unemployment rate. Killing the stock market creates a so-called negative wealth effect, the opposite of Bernanke's wealth effect, and damages consumer sentiment, which dampens overall economic demand. Now, killing employment also dampens demand, putting downward pressure on economy-wide spending. So just as the Fed, so the Fed hopes people will buy less and travel less and eat out less, but not so much that there's mass poverty. It's, when you think about it, it seems like a pretty hopeless and frankly silly alternative that they've set up for themselves. So assuming they go through with it and cause a recession and damage the economy, I want to make a prediction right now on how the Fed will handle a deep recession. And if I'm wrong, I'm going to be happy to be wrong. And if I'm wrong, call me out on it. And I'll be very glad to live with a bad guess. So a recession consists of a reduction or a slowing down of demand, demand being the volume of spending in the entire economy. The spending can be stopped or slowed, with higher interest rates and less money printing. So the Fed can dampen consumer prices, but remember all the other outcomes of inflation, the malinvestment, stagnation, supply chain problems, and so forth. Those are problems related to real production. And we won't have a healthy economy again until production ramps up in a healthy way. So if you understand inflation properly, it's clear that merely killing the demand and killing consumer prices does not solve the entire inflation problem. So the scenario on this little prediction that I'm getting to is as follows. In the next bad recession, which the Fed will have caused, the Fed is going to do something new. They're going to, I think, target specific failing or faltering industries that they think need help. So many things may be crashing around them, but they're going to target specific companies that they'll make an exception to. And the Fed will lend directly to these faltering industries in the name of national security or national well-being or something like that. And I think they're going to do this because I've seen the Fed's growing willingness to lend directly to specific industries or to cities or to public companies during the COVID lockdown. So the Fed and the Treasury are really both in love with this idea. This is targeted money creation, new money thrown at specific industries or cities or companies. And I think it's their next step in their evolution as monetary central planners. And to them, to the government, one great advantage and appeal of this little gambit is that it gets money to a preferred crony without ever hitting the US budget, because there's no taxpayer money involved here. Now, I'm going to talk about this directed credit gambit later in further podcasts. Anyway, let's keep in mind that in mind. Let's see if it turns out as I believe it will. In the meantime, I just think the investment markets and the government and even the Fed are pretty complacent about things, kind of like this little meme here. And if that's true, that sets us up for some further downside disappointments and surprises as this inflation saga continues to play out. Okay, let's see how we're doing in time here. Oh, good. We still have a little time. Any questions come up on that or comments?
So we have another super chat from Jeff Bannister. Thank you so much for 20 Canadian dollars. And he asks, the public sector unions in the UK use their power to demand inflationary increases while still wanting more energy cost relief. The average Joe is not getting wage increases to pay for their increase. Comments?
Right. Yeah, it's true. So I read that in the UK, energy poverty, what is officially classified as energy poverty has hit 5 million people. And there's already, we probably shouldn't get off into an energy discussion, but you think about the pickle that the UK policies have gotten them into. They are killing their energy industry. They are inflating their money supply. and they're in a position where they are beholden to unions and other organizations. So they now have to redirect the resources of this failing economy back down to those people. And it's just a hopeless cycle of inflation. And eventually they'll probably get the wages up a little bit. But I guess my bottom line comment is, they have to, with the debts the sovereign debts that all these nations have today, they have to keep inflation high, wages low, and interest rates above. They have to keep real interest rates low so people can't save. And this is the only way they can get the middle class and the working class to pay back and defease the debts. In other words, they're going to do it with inflation. They're going to get the debt to GDP level or the debt to assets level down through inflation. It's very bad for working class people. And I just think Jeff Bannister just spelled it out pretty good there.
And also we have a super chat from Enric. Thank you so much for $5. He says, thank you for the detailed analysis and projections.
Oh, well, you're welcome. I guess I'm glad to hear someone say thank you, because sometimes I feel like I get a little wonky with this stuff, but that's okay. You know, people keep showing up. I'll keep doing it. Okay, so I would like to leave you today with something kind of permanent, something you can use to remember. It's something directly related to money creation. And so I want to tell a little story that I made up, and I hope you enjoy it. It'll help. Maybe if you're talking to somebody over a beer and you want to tell them exactly the real nature of inflation, of non-productive money creation, the real nature of inflation, you can give them this story. So I would like you to imagine, and maybe you don't have to imagine, some of you are already. I'd like you to imagine that you're a student and who needs money to pay your college tuition and to pay your living expenses. And lucky for you, you have a benevolent Uncle Jay and Aunt Janet pictured here, who think you are just awesome, and they agree to lend you money at a pretty low interest rate. So let's say they loan you $100,000 and they charge you 5% or $5,000 per year in interest. And you have a part-time job, so as long as you're frugal, you can pay the $5,000 in interest. But of course, you have to work hard to do it. It's a little bit of a struggle. But then one day, Aunt Janet comes to you and she says, you're so deserving. Why don't you keep paying us the interest on the loan? But you don't ever have to pay back the principal. Instead, we'll keep renewing or rolling over the loan every time it comes due. So we'll keep relending you the money as long as you keep paying the interest. It's like a perpetual bond. Well, then next kind old Uncle Jay comes along and he says, we don't really need the interest either. So just keep paying us the interest, but then we'll give it right back to you to pay for your child care, which also happens to cost $5,000 a year. So while the money will still change hands as you go through the charade of paying interest and then getting it right back, neither the interest nor the principal on this loan will ever have to be paid back out of your pocket. And isn't this just like having no loan at all? How would that be different from getting a $100,000 gift and a $5,000 annual stipend from Uncle Jay and Aunt Janet? But now let's add one more twist. Suppose that one day by accident you discover a printing press in the basement of Janet and Jay's house, and you discover that the money they loaned to you was not money they saved. It was just money printed up, made up, counterfeit money. Well, wow, I guess everybody made out okay, right? You got a free education. The world gained an educated person, you. to add to the nation's employment rolls. Uncle Jay and Aunt Janet got to express their undying generosity and love to you, even though it actually cost them nothing. And of course, overcome with their altruism, Janet and Jay didn't think of the many invisible people who were harmed by their little operation. The other students, the workers, the consumers who were priced out of the market because, Jay and Janet decided to front run the market with their fake money. They did not consider that by purchasing things with made up money, they were getting something of value, that is your college degree, while giving nothing but paper in return. They did not consider that by consuming without first producing, they were watering down everyone else's wealth. They didn't comprehend that by draining the economy's pool of real savings without putting anything back into the system, they were stealing from everyone. And they did not consider the phony price signals that they were sending by adding fake money to the economy. And neither they nor anyone else could visibly detect the destruction caused by the resulting malinvestment, because only prices can measure investment results, and correct prices are distorted and corrupted by counterfeit spending. All this destruction was invisible, but it would not have been hard to comprehend if Janet and Jay were not such pretenders. Now, okay, so you've probably connected all the dots in the story with reality, but nevertheless, let me outline the parallels in this story to the real world. When the Fed buys a treasury bond from an investor, it pays the seller with brand new made-up money. When the Fed receives interest on those bonds from the Treasury, it pays that interest right back to the Treasury as dividends. Thus, the interest cost to the Treasury is neutralized. It costs nothing. When a Treasury bond matures, the Fed simply buys a replacement. Rolling the debt in this way ensures that the money supply does not shrink. Now, this is how U.S. government debt is monetized, that is reorganized into spendable money. The bond debt is extinguished and the bonds are replaced with new money. It's just like the loan from Aunt Janet and Uncle Jay. It's as if the government debt never existed. It's been replaced by new, unearned money. And this is why government spending, when it is financed by monetized debt, is inflationary. Now, the main difference between my little story and the Fed's operation is that in the story, you discovered the printing press in Jay and Janet's basement. By contrast, very few people understand how the printing press in the Fed's basement works. But hopefully you, if you read Hard Money Jim, will understand that. Okay, so here's how to reach me. Notice there that I've noted the interview we did with Brian Simpson on his book, A Declaration and Constitution for a Free Society, which was very interesting. If you haven't listened to it, it'd be probably worth your while. We probably have a little more time. Any more closing questions or?
We got one more super
Quotes?
chat from Stephen Lamb. Thank you for $20. He says, thank you, Jim, for the presentations and practical advice.
Oh, okay. So you're welcome, Stephen. And the only thing I'll say is what I'm telling you, I hope it's practical advice. I hope you don't consider it as any kind of specific investment advice. When I'm making comments about investments, I think they're at the extreme, meaning I have a very strong feeling about it, but I've been wrong a lot in my career. So do your own homework, get your own advice from a competent advisor. But anyway, thank you, Stephen, and thanks for listening. I appreciate it. Okay, I guess we'll call it a wrap there. Thank you until next time. Everyone take care.